Gold, XAU/USD, price forecast, undercut setup signals potential bottom. Gold is currently testing a major support confluence where an undercut and run setup could signal a potential structural reversal. While the long-term bullish narrative for precious metals remains structurally intact, aggressive near-term liquidations have pushed the asset into a critical inflection zone. The market is now balanced on a razor's edge. A successful reclamation of broken support could trap late-stage shorts and ignite a powerful short squeeze rally, though substantial downside risk remains if institutional buying fails to materialize at these key levels. Support confluence under pressure. Gold dipped to a new corrective low of $4,024 during Thursday's session, following a decisive failure to find sustained bids near the prominent March swing low of $4,098. This breakdown initially triggered a wave of stop-loss liquidations from retail buyers, accelerating the intraday drop. However, instead of entering a freefall, the price action quickly stabilized as gold entered a dense area of technical support confluence, suggesting that the broader corrective phase may be nearing a terminal bottom. The March swing low, $4,098, a highly visible structural pivot that acted as the initial psychological line in the sand. The 61.8% Fibonacci retracement, $4,067 drawn from the major long-term upswing starting at the May 2025 swing low. In institutional trading, the 61.8% level is widely recognized as the golden ratio, the ultimate threshold for distinguishing a healthy market correction from an outright trend reversal. Long-term uptrend line, a multi-month ascending support line that connects the major higher lows of the past year, providing an algorithmic baseline for trend followers. Measured move ABCD target, the current levels mark the exact 100% Fibonacci projection, $AB equals CD $, of the dominant corrective channel, a structural symmetry target where harmonic sellers typically take profit and buying pressure naturally re-emerges. Historical basing value, this entire price pocket directly aligns with a tight consolidation and accumulation zone carved out in November 2025, offering a historical footprint of heavy institutional accumulation. Reversal conditions begin to emerge. Together, these indicators suggest that gold is flushing into a high-probability zone where a macroeconomic reversal could develop. However, from an execution standpoint, it is not yet entirely clear whether the market will require further testing, double bottoming, or a prolonged consolidation phase before a definitive rally begins. Nevertheless, Thursday's volatile price action shows the classic hallmarks of an undercut and run setup, often referred to in institutional circles as a liquidity hunt or a bear trap. In this setup, sellers maintain complete structural control early in the session. They deliberately push prices below a highly visible support level, $4,098, to trigger automated sell stops and force weak-handed longs out of the market. Instead of printing a sustained bearish continuation, the momentum suddenly dried up at $4,024. Aggressive buyers stepped in, taking back intraday control and sparking an impressive short covering rally. The session ended with gold recovering nearly all of its losses to close with a net gain, securely back above the prior structural lows, trigger levels and market response. To transition this setup from a potential intraday bounce to a confirmed daily bullish reversal, buyers must clear a specific structural hurdle. The primary confirmation trigger rests at $4,220, the exact high of Thursday's volatile session. A daily close above $4,220 would validate the failed breakdown and signal that the market balance has structurally flipped from supply dominant to demand dominant near this key pivot zone. The law of failed patterns. In technical analysis, some of the sharpest, most aggressive market expansions occur directly in response to failed chart patterns. When a clear bearish breakdown fails to yield follow-through, trapped shorts are forced to buy back their positions to manage risk, while momentum-based breakout buyers simultaneously join the fray. This dual force can create an explosive upward trajectory. Despite the bullish intraday price action, conservative market participants should treat this as an advanced entry technique. Because the market has experienced high volatility, a retest of the $4,024 to $4,067 demand zone remains highly possible. Smart money often retests these swept lows to confirm that selling pressure has been entirely exhausted before committing to a multi-week trend reversal. Lower support risk scenario. No technical setup is guaranteed, and risk management remains paramount. If buyers fail to defend the integrity of Thursday's low and the ascending uptrend line on a daily closing basis, the bullish thesis is immediately invalidated, opening the door to a deeper capitulation phase. If gold breaks cleanly below the $4,024 macro anchor, the next major lower target zone rests between $3,929 and $3,873. This deeper downside pocket is defined by a prominent prior resistance turn support structure from mid-2025 and perfectly aligns with the 127.2% Fibonacci extension of the primary ABCD corrective pattern. A slide into this territory would indicate that the broader correction has evolved from a standard market pullback into a more severe, macro-driven markdown phase, forcing a complete reassessment of the medium-term Elliott wave cycles. Traders should watch the $4,220 trigger line closely for confirmation of the bottom, while maintaining strict stop placements below the $4,024 pivot.